Hello and welcome to the video. My name is Brandon, and if this is you, WTF is an ETF, well, you've come to the right place. In this video, I'm going to be talking about everything that you need to know about ETFs or exchange traded funds. So if you haven't seen my most recent video on mutual funds, I would highly recommend you go check that out, because an ETF is very similar to a mutual fund in that it's like a basket or a fund built up of assets, with the main benefit of providing a very good level of diversification. But there are three key differences that sets aside ETFs from mutual funds, and let's get into those right now. So the first difference being that ETFs are what we would call passively managed. So we can think back to a mutual fund, which is actively managed, meaning that every mutual fund would have a portfolio manager that's assigned to it. And they would constantly be buying and selling stocks and adjusting their portfolio with the goal of outperforming the market. And before we get too deep into things, we should probably look at what do we mean when we say the market or the index? Well, in North America, there are two main indexes that we should know about: the S&P 500 index and the TSX Composite Index. And an index is basically just a way of looking at a group of stocks. And whether this is a good analogy or not, I'm gonna give it anyways. You can think of an index like a catalog. Like if you went into the Louis Vuitton store, you'd have all these different products, bags, purses, wallets, but then you'd have the catalog, which is basically just a way of viewing or listing those products. Same as an index, like the S&P 500 index. This index includes the 500 largest companies in America. So companies like Apple, Google, Coca-Cola, Walmart, they would all be part of this index. And again, this is just a way of viewing them. And I'll bring up a little clip here on Wikipedia to show you what I mean. So here we have a list of the 500 companies that would be included in the S&P 500. So you can scroll down the list, you'll probably recognize some of these names. Companies like Activision Blizzard, Adobe, Alphabet, Amazon, AT&T, Bank of America, Berkshire Hathaway, Best Buy. I mean, all of the big US companies, they'd likely be included in this index. And as you can imagine, the S&P 500 is a great way of monitoring the US economy or the US market. Then in Canada here, we have the TSX index, which stands for the Toronto Stock Exchange Index. And as the name implies, this index would track the big Canadian companies. Companies like Royal Bank, Loblaws, BlackBerry, they would all be included in this index. And this would be a good way of monitoring the Canadian economy. I'll bring up a little screen recording here just to show you as well. So the S&P TSX index, here we have some of the companies: Air Canada, Bank of Nova Scotia, Bank of Montreal, BlackBerry. The big Canadian companies would be included in this index. Now, technically, you can't buy an index. You can't buy the S&P 500. You can't buy the TSX. It's an index. But what you can do is buy a fund that tracks these indexes. And that's exactly what an ETF is. An ETF sets out to mirror or replicate a specific index. So exactly how the index looks, an ETF would go out and buy the exact same stocks in the exact same proportions to basically create a mirror image of that index. And as the index fluctuates, the ETF would change as well. There's no portfolio manager, it just tracks the index, is passively managed. Example, today, Apple is the largest company in the world, and it represents about 5% of the S&P 500. And for an ETF that tracks the S&P 500, well, it would have a 5% weighting to Apple as well. And the same with all the other companies in the index, all the way down to the 500th company. Now, who offers these ETFs? Well, in Canada, there's two main providers: iShares by BlackRock and a company called Vanguard. And there are other ones like Horizons, but these are definitely the main two. And then the big banks, of course, they all have their own lineup of ETFs, but in my opinion, I think BMO has the best selection. Now let's move on to our second difference between mutual funds and ETFs. And because ETFs are passively managed, they have an extremely low cost. And this is by far one of the best benefits to investing in an ETF. Because they don't have a fund manager to pay for, they don't have to do research, they're basically just tracking an index, the MER would be substantially lower. And if we recall, a typical MER for a mutual fund would be around the 2.5% range. With an ETF, they can be as low as 0.08% or 0.05%. So very, very cheap. And to show you this, let's take a look at the screen recording right here. All right, so we're looking at a screen clip or like a snapshot of a specific ETF. And in this case, we're looking at a Vanguard ETF, ticker VFV, which is the S&P 500 index ETF. In other words, this fund is set out to track the S&P 500 index. And below we have some information for the fund, so the objective, the investment strategy. We can scroll down to see some of the returns from this fund. But right up here over to the left, we have the management fee. So the MER for this fund, 0.08%. So very, very cheap in comparison to a mutual fund, which is 2.5%. This is 0.08%. So substantially cheaper. And we can scroll down here just to check out the rest of this fund. And again, because this fund is tracking the S&P, it's an index fund or an ETF that tracks the S&P, the holdings are going to be exactly the same as what we would expect to see in the S&P index. So for example, right now, currently the top holding in this fund is Apple, Microsoft, Alphabet, Amazon, Facebook, Johnson & Johnson. That would be an exact replication of the S&P 500. Now, the third difference between mutual funds and ETFs is that ETFs are traded on an exchange. And this is where they get the name exchange traded funds. They're a fund that trades on an exchange. And they are structured just like a stock. So there'd be a bid price, there'd be an ask price, they trade during market hours, in comparison to a mutual fund, which is technically an open-ended fund, meaning that investors can come, they can buy units, they can sell units, they can constantly be putting money in, taking money out of the fund. So with an ETF, you'd pay a commission to buy and then a commission to sell, very much like a stock. There wouldn't be this deferred sales charge or front end or initial sales charge. That's strictly for mutual funds. Now, there's two things that I want to bring up regarding ETFs or index funds. Number one, statistically, about 80% of actively managed funds, so mutual funds, they fail to outperform the market. Meaning that when you invest in a mutual fund, you're paying a higher fee for this active management, yet 80% of the time, you're better off just investing in an ETF that tracks a market and accepts the return of the market. So that alone tells you quite a bit. But we can ask the question, why is this the case? First off, it's very difficult to predict how the market's going to react, even for these experts. And sometimes they will make the right choices, but to consistently outperform the market, over a long-term basis, that's a very difficult task. And a big reason that their funds don't beat the market is because of the fee that these mutual funds charge. I mean, if a mutual fund charges like a 2.5% MER or 2.5% fee, come January 1st, the fund manager is basically starting in a hole or in a negative position. And even if throughout the year he does very well and he manages to outperform the market, let's say the mutual fund returns like 10% and the market returns 8%, well, once you factor in that 2.5% fee, you're better off going with the index fund or the ETF. And of course, as investors, we have to think in absolute terms, what's the better choice? So very difficult for a fund manager to, year after year outperform the market when they factor in that fee that they have to overcome. Now, on to the next point. Is it fair to say that an ETF is always better than a mutual fund? This is a tough one. If we talk strictly statistics, ETFs have the lower fee, and if 80% of the time they perform better than a mutual fund, it's pretty obvious which one wins. And if we had the power to just close our eyes and fast forward to age 65, I would absolutely say, yeah, ETF is probably the better choice. Lower fees, better long-term performance, you're set. But a big part of investing is the ride or the journey and all the emotions that come with it. And when you invest in an ETF or an index fund, it would typically be a more volatile ride. Take for example in 2008 when the S&P dropped nearly 50%. Well, if you were investing in an index fund or an ETF that was tracking the S&P 500, your portfolio would be down 50% as well. Versus a mutual fund, where let's say the fund manager is doing a good job with the proper portfolio management, he theoretically could reduce some of that downwards movement. And I can give you a prime example of this. It's a little bit of a history lesson, and it goes back a little bit before my time, and maybe before yours too, but there was a company called Nortel Communications. And this was a big Canadian telecom company that was founded in Montreal. And at one point, this company was just so freaking big that it made up over 1/3 of the TSX index. Its market cap was just that big, and it dominated the TSX. So if you invested in an index fund that tracked the TSX, well, 1/3 of your investment would be in a single company. If you had $10,000, 1/3 of that is all invested in one company. And I think anyone can agree that's just far too much concentrated risk in one company. And yes, of course, in 2009, the company filed for bankruptcy. So one of the few downfalls to an ETF is that they have no discretion or no flexibility when it comes to the investments. Whatever the index is, it tracks it. Whereas with a mutual fund, because it's actively managed, the portfolio manager could say, whoa, this company's far too overweight, it's far too overvalued. Let's reduce our weighting to it, maybe cap out our exposure at like 5% or 10% of our portfolios. That being said, I'll conclude this video by saying, at the end of the day, an ETF is still probably the investment vehicle that I would recommend. There's a reason why they've become so damn popular over the past number of years. Because the fees are just that much lower, and because passive management or a passive investment strategy continues to be very successful, more and more money just keeps flowing from mutual funds to ETFs. You could argue that they're basically killing the mutual fund industry. And that's not to take away anything from a mutual fund. A mutual fund is still a great investment vehicle, and they're perfect for certain investors. But especially if you were planning to be a little more hands-on with your portfolio, like if you were gonna open up a Questrade account or a self-directed account and do things yourself, I would absolutely recommend going for an ETF or an exchange traded fund. So that's my video on ETFs, and thank you for watching. If you have any questions or comments, you can leave them below and I'd be happy to answer them. And if you like this video, give it a thumbs up and subscribe for more content. And I thank you for watching, and I'll see you in the next video.